Have you ever skipped a trade because it didn't fit your rules perfectly, but then wondered if you were being too rigid? This trade forced me to understand discretion. My name is Bai. I document my journey to becoming a consistently profitable trader, wins, losses, and all. With that said, let's jump into the chart. Here on the 15-minute chart, we've gone back in time to just before early hours of the New York morning session. We'll zoom out even further and see that we're bearish in our order flow. We have a swing high here and a swing low. We've even built up nice liquidity along this swing low, suggesting that price is ready to take that at any moment. We're also noting previous day's high right here. If we zoom in closer, we can see that previous day's high aligns with the previous day's Asia session high, and price has already approached this once without mitigating it, telling us the markets could be inducing early sellers. We've already taken London high, so it's logical to assume that previous day's high will also be taken before price realigns with the 15-minute bearish order flow. Now, with all that context in mind, there's still a problem. If we zoom out and apply a Fibonacci retracement on our swing high and our swing low, we can see that all of our price action right now is well under the 50% level, telling us that we're still in the discount of this bearish leg, which is not where you ideally want to be when looking for shorts. Now, normally this would be a no trade situation for me, but it's this most recent previous day high and it's obvious liquidity that's keeping me fixed to the chart. If buyers and sellers are fighting for control, liquidity is where the battle happens. It's kind of like a standoff. Who's going to give up first is the question I ask myself. If I get confirmation that price is moving to the downside, then I may have a case to jump in, even though we're not in the premium area of the bearish leg. Around 8 a.m., previous day's high gets mitigated. At this point, I drop down to the 1 minute for entry confirmation. Now here on the 1 minute, I'm not guessing. If I want to short in alignment with the 15-minute order flow, I need to see demand in overrun. Specifically, I want to see this key level get run by sellers, because this was the last area where demand came in and moved aggressively up, breaking structure to the upside and leaving displacement. A few minutes later, we get the break we were looking for. It's a clear structure shift where we have displacement. Buyers have stepped aside and sellers are in control. We can also tell that sellers are in control because of the bearish engulfing candles we see on the way down. That's my confirmation. For an entry, I'll target this 3-minute fair value gap. Stops above the high, and I'll target Asia session low as a final take profit. Price tags us in and chops around a little bit, but we're still in profit for now. But it's not long after that price melts and we hit our full take profit. It's a clean win, but let's ignore that for a second. This trade wasn't about the profit. It was about discretion. Price wasn't in premium. That's normally a deal breaker, but liquidity was obvious and confirmation was clear. So I ran the probabilities very quickly. Would this work every time? Probably not, but today the odds were in my favor, and my job isn't to predict, it's to execute when the conditions align. To me, that's discretion. I'm starting to see that discretion isn't breaking your rules, it's understanding when context slightly bends them without abandoning structure. That's what this trade taught me. I'm not a guru. I'm just documenting my journey toward consistency using market structure, supply demand, and price action analysis. If you're on the same path, then subscribe and let's keep sharpening our edge together. If breakdowns like this help you see the charts differently, check out this next video right here and I'll see you there.